and exit. So we've set the first cab off the rank. We'll be able to announce names, etc., of who they are soon. And we've got a couple more cabs that we're watching, these investment manager groups, and they'll be mandated to be out there doing that.
And you've also identified the rural and agricultural sector.
Yeah.
What sort of investments could you make there?
Well, what we've done, I mean, it's probably important to emphasise this is a global strategy, and of course New Zealand will have a slice of the action, given that's, it's one of the world's best farms. We're looking at, if successful, between $300 and $500 million allocated over the next 3 to 5 years. And we're going through a process both globally, identifying, as well as domestically. We're identifying, again, managers, good groups of managers who can manage a portfolio of farms. And we're really interested in the returns to the farm gate. So it is a rural land strategy. We can get access to the returns beyond the farm gate in many different ways, by buying global shares or whatever. So it's that farm gate, and it's in large part driven by riding the wave of population growth, demand for protein, scarce resource, so land and rainfall.
And obviously there are some well publicised groups of farms around the country that are for sale now. The Crayford farms, possibly farms associated with South Canterbury Finance. That sort of cluster of farms, is that of interest potentially?
It's too early to rule out anything. The strategy literally is at the stage now of us getting down to the short list of potential managers for us. It's going to be up to them to then say which particular group. We don't mind clustering of farms because part of a global portfolio, it doesn't have to be diversified just in New Zealand. It can be, it's diversified globally. So, it will really be up to the managers to say, this is what I'm going to do, and they, they'll have their own capital in the game as well. So our interests will be aligned, and they'll have to run hard for it.
And at the moment, what percentage of the overall fund is invested in New Zealand, and do you see this rising much further? How far ultimately?
We're roughly, and sorry if I sound inaccurate, but we're just south of around 20% of the fund invested in New Zealand. There's a higher number if you include the cash liquidity we deal with. But that's, to shift it a lot further north of that is going to depend on the investment by investment stages. That's why we're quite interested in taking big bites of big things, because that really does shift the dial. But it has to be to the benefit of the fund. It's a purely commercial operation.
In that sense, what was so appealing about the Shell investment for you?
All of the features that we hopefully can find in our direct investment strategy. It was big, and hence there weren't that many players who could step up with a cheque that size. It was a long-dated asset with plenty of room for growth, both capital growth in terms of doing different things with the assets, but also just a long-dated, it's here, it's going to be around for a long, long time, retailing of energy. So and there weren't that many people who could come into the room or wanted to be in the room, so we were left in a relatively rarefied atmosphere for negotiating a good entry price.
So there was a little bit of opportunism there in terms of,
absolutely,
if there weren't a lot of buyers lining up for it.
That's right. I mean, for long-term infrastructure assets, you really have to make sure you enter it at the right price at the right time. That's a really important trick. I mean, a big part of a lot of the distressed assets you see globally now is, buying at peaks. And that's an important thing for investors to remember, wider New Zealand, which they don't, is that when markets are down, that's a great opportunity for us. The saddest time to be buying a house in Auckland is at the peak. For us, we're purchasing assets. We want to be, in there when it feels uncomfortable.
You've got an estimated target return for the coming financial year of 8.65%. Can you just briefly explain to us how you come up with that figure?
How's that sound? I mean, 8.65 is incredibly spuriously accurate. The wonderful thing about financial markets is no one can forecast a year ahead with any accuracy what the returns are. So what we do is we say, looking, we have a very clear idea on average over time what financial returns will be. So we look at a 10-year estimate of returns, and then we say, now, where are we relative to that level of returns? So you take your long-run equilibrium return, and we say we're currently south of that, and hence we'll probably grow a bit faster than the long-run average because we'll be converging back to that trend level. And so really it's just backed out like that. Huge confidence intervals around them, or lack of confidence intervals, I should say.
And the long-term target, of course, is to exceed the rate of return on treasury bills by 2.5% over rolling 20-year periods. I think last I looked you were a little behind that, but obviously you haven't been around 20 years yet.
That's right. We've had, of the 7 years we've been investing, I think it's something like 5 years we were ridiculously north of that return. We were 2 times the risk-free rate at some points. We've come through the global financial crisis. We were half of that return. But on a rolling basis, we're now north of the Treasury bill rate again. So the emphasis there is it's long-term returns and not to be spooked by mark-to-market opportunities. And that is the true advantage of a long-term investor, that we don't have to be spooked by mark-to-market moves.
And you've obviously had a very dynamic period while you've been at the fund with the global financial crisis. Now we've got this European sovereign debt crisis. Yeah. How big of an issue and worry is that for you and your position?
I must say, if you're going to have a crisis, you want it early on in the life of a fund. So it has actually been relatively opportune in some macabre fashion. One, what doesn't kill you makes you stronger. As a team, we're battle hardened now. And two, that with the weight of money still ahead, when you can be buying assets during these downtimes, you want to be doing that at the early time of the fund with a big horizon forward. The European situation at the moment, of course, it's always a concern. I have to say I'm personally still very optimistic on a 3 to 5 year basis. We've gone through in our lifetime the most incredible period of per capita income growth globally. It's outpaced anything we've seen in the previous 1,000 years, and I don't see anything on the horizon to be changing that. I can only see things to accelerate it at the moment. So yeah, they'll go through this, the debt side, there'll be fiscal retrenchment, there'll be people wanting to come or go, but we'll be looking for the opportunities throughout that period. Earnings growth, price relative to earnings growth at the moment that we can see is looking very healthy.
Okay. Well, this is Gareth Vaughan from interest.co.nz with a double shot interview with Adrian Orr, the CEO of the New Zealand Superannuation Fund. Once again, thanks for coming in, Adrian.
Thank you.
And good luck.
Cheers. Thanks, Gareth.